Guys, pay close attention tonight to what you're getting ready to hear. This diversified cash flow account is, to me, and I keep saying this to Indamo, I feel like this account is a way to be able to put your savings on steroids. Okay. And I don't like to use drugs as an analogy, but
turbocharge.
Turbocharge. Exactly.
Turbocharge
your savings. And it has so many unique features and benefits to it that you're going to simply be blown away. Diversified cash flow account is more of a savings vehicle that provides you with guaranteed uninterrupted compound interest. All right. With dividends. Okay. Guaranteed uninterrupted compound interest with dividends. Now, it also allows you to have fast access to a large portion of the money that you use to fund a diversified cash flow account. So with that, love you guys. I appreciate you. And Damo, I'm going to turn it over to you and our special guest. All right.
Okay. No, absolutely.
Thanks,
I appreciate that. Appreciate that, Brian. And I want to just say this. We are, I'm going to let our guests let you know their credential, but I'm about to introduce we're going to call our lead diversified cash flow, or DCA, because that's where, we say PRA. So DCA is what we'll call this, but our lead experts. These are the two experts that have locked arms with us to go really do something special. They've actually joined MWR. That's another powerful thing because they see the power of MWR. So with that being said, I'm going to bring on Edward Pritchard and Ike Manello. Hello, gentlemen. How are you both?
Fantastic.
Good evening.
Good evening. Well, I'm going to get out of the way. I've been fumbling and bumbling. I don't know why I can't talk tonight, but I'm going to get out of the way, and I'm going to allow you two to kind of let everybody know what a diversified cash flow account is and why it's so important and what it's going to do for people here at MWR.
Absolutely. Well, hey, I'm fired up. I mean, like you just said, I was at the conference. I got a chance to not just feel the energy of the people. I got a chance to meet you. I got a chance to meet Brian. And it was definitely a life-changing event and made us even more excited to partner with MWR. So we're excited to roll this out. I'll just introduce myself and my partner. I'm Ike Manello, Edward Pritchett. And I like to say this. So together we have over 750 advisors, done 56 million in premiums last year. We did. I mean, I could just go on and on and on. And the reason I can do that is because my business partner, right? I joke around about this, but for you guys that watch basketball, a while ago, Steph Curry scored 60 points and Draymond Green scored 5 points. And then the next day, Draymond tweeted, we combined for 65 points, right? So that's how I feel whenever I'm with my business partner, Edward. So, Edward, I'll let you say a couple of things before we get started.
That's what I'm excited for each of you, is that you have a system like MWR that's empowering you with education, with knowledge. I mean, it's for lack of knowledge, that's why the people perished, right? It wasn't for lack of money. There's plenty of money out there. It wasn't for lack of resources. The resources are out there. It's the lack of the knowledge of how to use those things together. And so I'm excited to bring this diversified cash flow account to you all, to be able to share in that. And to be able to celebrate some amazing wins over the next couple of years. Not like, we're not talking about 10 years in the future that we get to celebrate wins. We're talking about like in the next year and 2 and 3 years, some big wins are going to be able to happen for some people who implement the strategies that we're going to talk about, work with our advisors and experts to really get themselves set up correctly, and then just build and compound on top of that. So as you mentioned, we have a lot of clients all throughout the country that take advantage of different aspects of the products that we use. I've been in this industry now for 15 years, and it took 10 years for me to fully understand and be able to bring what we're talking about with the diversified cash flow account to the table for middle America, because this is something that's typically been reserved for wealthy Americans, where, I mean, it takes hundreds of thousands, sometimes millions of dollars to kind of get this thing started. But about 5 years ago, it wasn't just me. Like, it was some mentors of mine that were like, okay, here's how you can make it work for anybody. And they kind of keep this a little bit hidden because they don't want everybody to know about it. But Now we're able to really share this in this open format and empower so many more people to take advantage of this product. So I'm really excited for that. And Ike, I know you're going to be able to really explain, because fundamentally you have to be educated and understand why this works. And then once you understand the why, right, when you understand how banks are doing this every single day, then we can talk about how it can work for you. So I'll turn it back over to you, let you jump into the why, and then I can come back and talk about the how. And I'm sure we'll have some questions pop up here and there as we go through. I don't know, there's a whole bunch of comments flowing in. So I don't know if we'll have just question comments, but we'll try to get to as many as we can right now. And I'm sure we'll be able to get back. We're going to be doing a lot of training over the next few months with MWR, a lot of videos that we've already recorded and are going to be released so that you can really understand what this is and the power that it's going to have to allow you to grow your money in multiple ways at the same time. So I'll turn it back over to you, sir.
Absolutely. So want to make sure, first of all, everybody see my screen okay? Edward, good go?
Yes, sir.
All right. So I want to start out by asking a few questions. I want you to take a minute and read these questions, because what's going to happen whenever you read these questions is there's going to be something that happens inside you. Because when you hear double your cash flow, eliminate debt, self-grow your money like banks, when you hear that, and then you look at the bottom and you see without working harder, changing your lifestyle, or spending any extra money, I want you to notice what happens inside you. Because for most of us, what happens is we start feeling like this is too good to be, and I'll let you finish off the rest. So the reason that's important is because a lot of us have been taught things that for a long period of time we thought was normal. And so I love that this says, because it says, look, it's not what you know that you think is true, it's what you think you know that just isn't so. And so one of the things that we know in this society is there's secrets, okay? And the number one thing that most people in this industry, most people in the world look at as far as the top 1% is, number one, eliminating debt. Number two, maximize savings, liquidity, and leverage your finances. And number three, decreasing taxes. So the top 1%, these are the first three things they look at. Hey, we need to eliminate debt. The 1% does not play with debt. Next, how can we maximize and leverage what we have? And then number three, how can we lower taxes? So the beauty of the diversified cash flow account is all of those things happen in one. So I want to ask you a few questions. Number one, are your dollars going to be worth more than today than they are tomorrow? And when you think about that, there's a purpose behind that question. If we know for sure that the dollar today is not going to be worth as much as it is later, we have to ask ourselves, why are we putting money in vehicles to where we defer that, right? Then we go on to the next question as far as what taxes. Is taxes going to be going up or down? Take a minute and just think about that for a second. If we know for sure, because I think most of you, I can't hear you, but I think most of you would say that you taxes are probably going to be going up. So if we could combine these three things and we take a look at this and we know that taxes are going to be going up in the future, the question I'd ask everybody is, why would we put our money in places to where we defer our taxes if we know we're going to pay taxes at a higher level and get penalized later on? The answer for most of us is that that's just what we've been told. We've been told to put our money in places to where we defer taxes. We've been told these strategies, and sometimes you got to ask yourself, if we're told these strategies, what are the masses doing? Because most people will say, hey, the stock market is bad. But the truth is the stock market isn't really bad. We just have to understand what we're dealing with. The experts will tell you in Wall Street that you're going to get a 7 to 9% return in the stock market. But the truth is, when you look at the fees, when you take out all the fees and everything, the average investor really gets about 4.2% in the stock market, which is okay. So that's the part I want everybody to know. That part is okay if you're going to deal with stocks, as long as you know the risks. So what we're going to be talking about is how to gain that same 4% without any risk and without changing anything you're doing right now. We've all heard compound interest, and I think most of us have applied it or try to apply it in a certain way, whether that's putting money somewhere and just letting it sit. But what we haven't heard is that most wealthy, most of the top 1%, they don't just let money sit. Their goal is to use money and as far as let it compound, but also use it while it compounds. And so we talk about some of these people. These are just some of the people that I'm sure you're familiar with. They've all used the Diversified Cashflow Account. They've used it because they've used it to let their money compound, but also to use at the same time. So two forms. The reason we talk about diversified is because we can let our money grow on one hand. At the same time, we can have access to our money. Okay. So let's take a minute and talk a little bit about how banks work. And I want you to think about, do you have a bank account? Okay. That's the first thing. Do you have a bank account? For most of us, the answer is yes. Yes, we have a bank account. Why do you have a bank account is the next question. And you're probably thinking, well, that's a silly question. We got to have bank accounts, right? Most of us in this world, we have to function with the bank. That is true to a certain level. So I want you to pretend with me for a second. Let's pretend that you found a bank that's going to give you 4% interest. Now, I know what you're thinking right now. What bank gives 4%? Because for most people, banks are giving what in savings? 1%, 0.8%. Let's just say you found a bank that was giving 4%, because this is important to understand how money works. Okay. And you're so excited about this bank that you deposit $100,000 in this bank account. How many people understand that the bank is going to take that same money and they're going to loan it to somebody at 7% to buy a home? That person that buys that home gave that money to the seller makes money, and then the seller deposits money into the bank. And guess what? That bank is going to use their money and they're going to loan out to somebody else to buy a car at 8%. This cycle continues because the car dealer is going to deposit that money in there. Then the money is going to be loaned out at 9%. Then you got the contractor. Then you got debt consolidation at 12%. So let's add this up for a second. How much more did the bank make than you? So let's take our 4% minus the 7% the bank made. That's 3%, right? Now we take the 8% minus 4%. That's 4%. We got the 9% minus 4%. That's 5%. So the banks are making this extra money. And so when you total all that together, it comes to 20%. Now, here's the $1 million question. If you made 4% and the bank makes 20%, how much more money did the bank make than you? For most of us, you're looking like, well, listen, I didn't have to go to Yale like Edward Pritchett to understand this. 20 minus 4 is 16. They made 16% more than me. It's actually 500%. Because if you made $4 and the bank makes $20, isn't that 5 times more than you? That's 500%. And for most of us, when you look at that, I know I went through that diagram a little quick. You're probably thinking, I don't know if that's true. There's a company called Bauer Financial that studies and that gives the statistics on most banks in the United States. Banks make between 400 and 1,300% on the money that you leave in there. Okay. And so you can go to Bauer Financial in order to get that information. But the reason that's important is because for most of us, you're thinking, well, of course, well, what can we do about it? That's just how things work. Well, what we're talking about with this diversified cash flow account is a strategy to bypass leaving money in banks and 401ks and different things that defer taxes, and put yourself in a position to do what most banks do. Put yourself in a position, put your money where most banks put their money. So I'll summarize this by saying this. It comes down to 2 strategies, 2 components. Number one, you have to be able to store your money in an area that's going to allow you to have control over it. Okay. That's number one, being able to have control of your money, but also number 2, being able to have it in a place that's safe and liquid. So being able to not just put your money somewhere, because we all agree, hey, I could put my money in this account, but if I'm going to lose it, then there's going to be a challenge. So you want to be able to grow your money, right, with the guaranteed growth, and you want to be able to have access to that money. Okay, and so that's where the diversified cash flow account comes in. And so what we're going to talk about now is more of the uses with the diversified cash flow account and some different examples that come across with that. The DCA is what we're calling it. So Edward.
Yeah. And I mean, what you were breaking down there is really the fundamentals, like how this works. The ideal that we see with the banks is that they take your dollar and then legally they can take your dollar and loan your dollar out 7 times. That's what a bank charter gives them the right to do, right? That's how they compound and compound and compound. Like they're letting a dollar that you're putting there, they're paying you 4%. 4%. Like we know that doesn't exist. I saw some of the comments. There's no banks that are paying 4% right now. I don't. It's just that doesn't exist, right? But they're taking that and then they're able to compound on it multiple times because they're using that same dollar 1 time, 2 times, 3 times, 4 times, up to 7 times. Now we can't do that. All right. Like unless you go and get a bank charter, like you cannot legally do that. If you try to do that, you will go to jail. The IRS will come after you. They're pretty good at finding those kind of things. But what we're able to do, and this is where Brian was talking about earlier, how this is very similar to the private reserve account that is already being used. The ideal behind the diversified cash flow account, though, is to make sure that there is no variancy in the market. The stock market, as you said earlier, Ike, the stock market is great as long as you know what you're going to get from it. And there's some years you're going to get great things from it. And there's some years where even in a private reserve account, that account's going to have to pay 0 because the stock market or the index that it was tied to was negative. Now, the great thing about the private reserve, you didn't lose anything, right? And that's one of the things we're trying to stop the losses at some point in time. And that's why that is a fantastic account for retirement, for money that I need to use in the future when I have that time. But what can I do for the here and now? Where can I use or set money into account, as those last 2 points that you were making, somewhere that's going to be safe and secure, that's going to store my my capital and allow me to continue to use it while it's continuing to gain income. All right. And so I want to actually jump into the kind of nuts and bolts and give you guys an example, be able to show how, using the snapshot, the financial snapshot that you guys will be filling out, how you guys will be able to share with our experts the different things that you're working on, like what's going on for you right now. And the more detailed, like, we understand that the privacy of, people like to kind of protect their financial privacy, but the more that you can share with us, the more detailed you're going to be able to get as far as an answer to here's how we can use a diversified cash flow account to actually set you up so that the funds that you're putting in, what you're saving right now, what you're wanting to set aside, can be used to do 2 things. One, it's going to allow you to pay off debt in the here and now, right? So that you can start eliminating debt. One of those first principles that Ike was talking about, that the 1% go after, how can I get rid of debt? And then number 2, allow the funds that you're putting in there to continually earn this 4% interest rate. So the interest rate on these accounts is typically between 3 and 5%. And we'll find that out when we're actually going through the process for you, where yours is going to be. But you can get that and get that continually. Actually be able to use that compound in your favor. And then while that capital is sitting there earning that income, you can then borrow against that, find actual leverage, and use those funds to do the other things that you need to do, whether that's paying off debt that's at a much higher interest rate, or, as both Brian and Andamo mentioned earlier, use those funds to invest in the things that you want to invest in, whether that's your business, whether that's real estate, whether that's that new home that you've been wanting to get. That's what we're going to be able to show you as we go through this. So are you guys able to see my screen now? Ike, you seeing that clear?
Yep. Good to go.
All right. So let's talk about this diversified cash flow account and really what it can do for you. Now, Ike had a couple of questions for you at the beginning. I have a couple more for you. Are you 100% sure you're going to have a great retirement, or do you have some doubts? Now, I think if we ask most people in this country that question, have some doubts is like that's like a light answer to what they would tell you, right? Because most people are going to be dependent on family and friends, Social Security, and a measly little amount that maybe they saved away in a 401k or an IRA. that they've deferred the taxes on, and now that they're pulling it out, they're getting that required minimum distribution. They're seeing how much their taxes are now on what they thought they were deferring. All right. So that's one of the things that this policy will help you with. This account will help you with. Now, it will also, just like the private reserve account, if you have both, now you've doubly helped yourself, right? You're being able to take advantage of this thing in two different ways. What if I could show you how to get out of debt in 9 years or less, including your mortgage, without spending any more money than you are today? And that's what we're going to show you, because I think that's the place where we all can say, here's where we can enter into this new game, this new way of looking at our money. Because a lot of people think I have to have, and this is what I thought for many years when I first got into this industry, that you had to have hundreds of thousands of dollars already sitting there to be able to put into an account like this, to be able to start using it. But that's just not true. And that's what I'll be able to show you here with the example of one of our clients here in just a second. Now, we all know debt is just running away. It's rampant, trillions of dollars of auto loan debt, credit card debt, student loan, mortgage debt. More than likely, everybody on this call has some or at least one of these things going on. And that's what policies that we can put into place to fund this diversified cash flow account will allow you to be able to eliminate all of this in a shorter amount of time than you think. Like, I know you guys already have plans to help you get out of debt in a structured way. And what this does is, Brian said steroids and Damo said turbocharge. Either one works. Like, this will help you make that happen that much quicker. So the typical American household, when we're looking at it, and I want to show this because I want to share at the end how we're going to switch this pie chart. Okay. The majority of Americans, they're putting 34% of their dollar that they earn paying interest. Just think about that. 34% paying interest, 40% in taxes. And some people are like, well, look, Edward, I live in a state, we only have a 20% state tax, or, I'm at the 20% federal level and we have no state tax. Well, are you paying sales tax on everything you buy? Your gas, your food, your car, your groceries? Are you paying taxes every time on your property? Are you paying, taxes it's a little insidious. Sometimes you don't think about how much is actually going to taxes. You think it's just the income tax rate and your state tax rate, but it's all the other stuff that gets added on top of that. Okay. So 40% going to taxes. Unfortunately, we can't eliminate that, but we can definitely mitigate it. We're really on 3% on the savings side. I hope that's the case. Unfortunately, what we've really seen is that most Americans are in a negative savings rate status, meaning that they're actually spending more money than they make because they're having to pay the interest, they're having to pay the taxes. They're definitely not cutting back on their lifestyle. And so they're not saving, they're actually borrowing more and getting deeper and deeper in debt. But let's assume that in a good world, people are saving 3% of what they're bringing in. And that really only leaves 23% for lifestyle, your food, the car you drive, the house you live in, like everything that you work so hard for, your 23% of your income is going towards that. And to me, that's absolutely, it's just ridiculous. How can we shift that, right? And that's what we'll show you with a diversified cash flow account, what that can actually look like. So let's talk about one of our clients, Renee and Anthony. And Renee and Anthony, I think they've now they were one of our earliest case studies that we did, because we tried to track over a long period of time how our clients use these accounts to really get themselves out of debt. And they started with us I think it's almost 11 years now. I need to go back and actually look at it. I know it was 10 years ago at the end of last year. So I think we're coming up on 11 years. But Renee and Anthony, 38, 36, they're making just a little over $7,000 a month in monthly income, wanting to retire when they're 65. They want to have $5,000 worth of income. As you can see, they have some kids, 3 of them. They have less than $100,000 in their 401k, no college savings right now. They want to eliminate debt. They want to save for retirement. They want to do the things that most people really want to do when they're kind of evaluating, okay, where do we currently stand? Where are we trying to go? All right. So this is where we're talking about that financial snapshot. The more information that we have, the better we can prepare your game plan for you using this account. We're finding out specifics on their savings and investment. And again, now you can just give us a general number, and when you're talking with one of our experts, they may ask you to break it down a little bit more, because what we're looking for, we're trying to be able to do this without you having to spend any more money than you're currently spending. And so if we can identify inefficient money, so that's money that you're putting into places that is not as efficient as it could be, right? The 401k, that's great because we think we're deferring taxes and it's going to earn that 7-8% return. But as Ike was talking about earlier, that's just not really the case, right? Like that's the education that we're getting. We're learning that that's not really the case. So is there a better place for me to put? Can I put that somewhere where if I still do want to invest in the stock market, I can borrow from my diversified cash flow account, go use that and invest in the stock market. I'm earning 4% over here. I'm getting a little bit ahead of myself, but like we can make that money work more effectively for you. Right. So the more information that we have as far as what's available there, what are you contributing monthly? Is that available to be reinvested somewhere else? Outstanding debt. Again, you can just give us the total amount, but by breaking it down, we can really get into, okay, where are the most high interest rate debt that you have, where there's some overpayments happening, how can we take care of that? So as you can see with Renee and Anthony, we got Visa, credit cards, medical and dental bills, furniture, auto loans, and of course, the biggest one is the mortgage. And we're going to break down the mortgage here in a second of why it's smart to pay that mortgage off sooner rather than later. Okay, so they had average interest of 9.25%, $180,000 in debt that they were working to pay down, and their payment was just over $2,100, just under really $2,200 a month in payments that they were making on that debt. Now, if they continued the way that they were planning on going, 30 years of trying to pay all this stuff off, this is assuming they get no more debt, right? Like they don't go and get another credit card, they don't go buy another car, they don't get any new furniture for the next 30 years. Now, let's be honest, like, is anybody going to do that? Of course not. We can say that quickly. No, we're going to get that new car in 2 to 3 years. We're going to get new furniture at some point in time. We're going to take the vacation. We're not going to stay in that house for 30 years. We're actually going to buy a new house every 5 to 7 years and start that whole cycle all over again. But if they just stayed with what they were doing for 30 years and paid that $180,000 in debt off, they'd have paid over $199,000 in interest on that debt. All right. So is what they bought really worth the $380,000 total that they're going to be paying of their hard-earned money for those things? Right. And that's money that they're never going to get back. Once they pay that out to that lender has it, and they have no more utility on that money. But we're going to show you how to keep that utility so that you can use your money twice. So let's look at the mortgage real quick. Okay. Real cost of interest. Now, if you had a 30-year fixed term mortgage for $300,000, that would be a $1,600 monthly payment if you have a 5% interest rate, which we're getting closer to 5% again, but we're still not back to 5% interest yet. And I know for some of you, you're just like, wait, I thought interest rates are still like 3%. Well, check the news. Like it's changed and changed very quickly, right? And that's the scary thing about where interest rates are. Luckily, most people are getting fixed these days. I think people have kind of learned about the whole adjustable rate mortgages, but even those are starting to come back. So what is the actual cost? When do you actually pay 5% interest on that mortgage? Well, let's take a look. So in year one, when you're making your mortgage monthly payment, you're paying $360 each month towards your principal, and $1,250 goes towards interest. So what is the interest rate of that? What interest are you paying that particular year in year one? Well, $1,250 divided by $1,610, which is my payment, is 78%. So 78% of my payment is going towards interest. That's just math, guys. I'm not making this up. I'm not trying to I'm just doing the math. So in year one, 78% of my payment is going towards interest. Does that seem like a 5% interest rate to you? Let's go to year 10. See if it gets any better. Year 10, my principal payment is $564. My interest payment is $1,045. Again, doing the math, $1,045 divided by $1,600, 65% of my payment is going towards interest. And remember, like year 9, it was worse than that. Year 8, year 7, year 6, year 1, right? Let's go to year 20. Year 20, 930 towards principal, 680 in interest. Well, at least more of my payment is going towards principal now, but it's still 42% of my payment is going towards interest. So when do I get to this magical 5% number that the bank told me I was going to pay? Year 30. I actually kept my home longer than 98% of the country keeps their home. And I pay $1,500, $1,532 in principal, and my interest payment is $78. Now I'm actually paying 5% interest, right? The banks front load getting their interest first, and you pay your principal off at the end, very end, right? They're making sure that they get theirs while you're just consistently like paying this monthly payment month after month after month for 30 years. So again, we tell ourselves these stories. Oh, I got a 3.25% rate. I got to hold on to that forever. Again, do the math. Do the math. Like, how much is going towards interest? How much is going towards principal? What's your total payment? So how much are you really paying towards that interest rate that particular month of that particular year of this great 3.25% that you have for 30 years? This is why we encourage our clients to use these accounts to pay off their mortgage sooner rather than later, because that's going to save you money. That's going to put more money back in your pocket, so that when you're ready to use that for what you want to, you still have it and the bank doesn't have that money. So the traditional approach for getting out of debt has been, working harder, spend less, save more, which is nice, but most people just don't do it. Refinancing, which that just pushes the ball down the road some. Consolidating, again, pushing the ball down the road. And debt snowball, which is great to debt snowball, but as soon as I pay that debtor, that money is gone and I can never get it back. With a diversified cash flow account, I can pay myself first, who I should pay first, and then pay my debtor, and I still get to keep my dollar. And so we'll talk about exactly how that looks. So when we do your financial snapshot, and we talk about reallocating those inefficient dollars, we're looking at your debt. We're looking at the minimum payment that you have to make. What are you actually paying? Because I know a lot of people are overpaying on debt to try to get it paid down. And we want to redirect those inefficient dollars into an account that we're talking about, so that you can, again, use that dollar twice. So with Renee and Anthony, what we were able to do for them, they were debt-free after 7.8 years, over $122,000 saved on interest. That $2,100 or $2,177 that they were paying per month on debt payments, we moved that into this account, and that is adding to their retirement every single month. All right, so how about that for a boost to your retirement? If you can add an extra $2,000 per month, $24,000 a year to your retirement, and now over the next 30 years, and now they're down to around, again, I got to look at the dates again, 19 or 20 years, but by the end, at just what they've been putting in thus far, and their scheduled payments that they're putting in, they're gonna have over $1 million saved for their retirement in their 30th year with us, that they can then use to fund their retirement in a tax-free way. Because anytime that they're pulling funds from this account, they're not paying taxes on that, because it's already their money. The taxes have already been paid. Even on the gain in this policy, the taxes are of no consequence, because the IRS sees this as a specific type of qualified account that isn't taxed. All right. So how does this work? So let's break this down. If you had $20,000 and you were going to buy a car, and I don't know what car you can get for just $20,000. So maybe it's not a new car. Maybe this is a slightly used car, but even used cars, you're buying a 2012 for $20,000 these days. But let's say you wanted to buy this car, you have $20,000. First option is you can pay cash for it. Now this makes sense. If I'm trying to eliminate debt, stay out of debt, save up the money and buy. There's a lot of great radio hosts and authors of books that say this is the way you should do it. And I don't entirely disagree with that. If this is a way that you can do it, fantastic. But I've always looked for like, how can I do it even better? How can I be more efficient with my dollar? What if there's a way to do this and I get to keep my $20,000 and keep the car? All right. So option B, let's say you take $20,000 and we found Ike's Bank that pays 4%. Again, we know it doesn't exist, but let's say we find that bank and we put it into a CD at that bank that pays 4%. And the special thing about this is the bank then allows me to borrow against that CD, but keep the principal there. So I can borrow 20,000. So they give me a CD at 4%. And they say, well, since you have this CD, you're allowed to borrow, $20,000, but we have to charge you 1% more than what we're paying you. Okay. If I was offering 1% loans to you guys right now, put it in the chat. Would anybody take a 1% loan to refinance or consolidate any outstanding debt that they may have, whether that's that Visa at 18% or your mortgage at 5.25%, right? Who would take a 1% loan right now? So this is option B. We put in that $20,000 that we have into a CD. That CD is going to pay me 4%. And then I get to borrow $20,000 from the bank. They're going to charge me 5%. Let's look at the math of what it looks like for option B, okay? So we have the $20,000 sitting in, and let's not call it my bond anymore, but let's call it my Diversified Cashflow Account. I know we've shortened that now to just Diversified Cashflow Account, and we took the CF and just merged it together. So DCA or DCFA, all right? But $20,000 at 4%. Year one, I'm going to make $799 in interest on that. Year two, because this is compounded, it stays there, it makes another 4%. Year two, I make $832. Year three, $865. Year four, $899. Year five, $935. So over a 5-year period of time, I've made $4,333 on the $20,000 that I have sitting there. Okay. But remember, I also borrowed $20,000 at a 5% interest rate that I'm going to pay back to myself. Because by paying it back, I make the money that I have on the other side, on the left-hand side, work more efficiently for me. So I borrow that $20,000 at 5%. Year one, I'm going to pay $848 in interest. Gonna keep paying that back. $749 in year two, $555. Year five, I pay $138. So I've paid a total amount of interest of $2,645 over the 5 years. Paid it all off. I have a car that I now own free and clear. And am I net positive or net negative in this transaction? And I think we all can easily see that, right? I made $4,335 or $333 on the left side. On the right side, I paid out $2,645. So I'm net positive over $1,600 in this transaction. Plus, I have this car that it's depreciated, I get it, but I own that free and clear now. I don't owe anybody for that. And my $24,333 gets to still sit there and earn money until I need to go. Maybe I want to buy a new car and I trade in this car, borrow another $20,000 and do this again. But this is how I get my dollar to work twice. And if you can understand this concept right here, if this makes sense to you, then you will understand why our accounts work. And how this is how you want to pay off that debt instead of just giving that money to the lender. And let's take a look at it from this standpoint. If you have $5,000 of debt, what's the smartest way to pay it off? Option A, just pay $5,000 in cash and give that cash away. And once it's gone, it's gone. Or option B, put $5,000 into my Diversified Cashflow Account bank, borrow $5,000. There's a 1 percentage point difference between what I'm making and what I'm borrowing. Pay off that debt, which is going to be at a higher interest rate than 1%. Because I dare say no one has a lot of 1% loans or 1% debt that they're holding on to right now. And then pay myself back over time so that my money continues to grow while it's sitting there. I'm paying much less out in interest. And this is how I start to build up and consolidate my capital in a place that grows, whether I'm using it to pay off debt or if I'm not. And I'm getting that consistently every single year. I'm not worried about if the market is up or down. Every single year, I know I'm going to be getting my 3 to 5% plus dividends that might be paid out by the underlying companies that are behind these accounts. So what's the difference? The difference is the average American approaches life in this way. They're spending 34% in interest, 40% in taxes. Over 74% of their dollars going towards that. What we can do with that diversified cash flow account approach is lower the interest to 22%. There's still some that you're going to be paying, but here's the thing. The longer you use it, the lower that number can become. Like if you're self-financing everything in your diversified cash flow account bank, then your interest rate should be more like 1%. So it could be a lot lower than that. But this is what we typically see in a short period of time for most of our clients. We lower taxes by 30% because we're able to stop worrying about deferred taxes in the future. And we can actually start talking about tax-free income in the future, because when we pull money from these accounts, it's a loan to ourselves. So the IRS doesn't see it as income. So that helps us lower our taxes. We're able to increase our lifestyle spend by by 10%. And increase by our savings by 12% because we're saving in our diversified cash flow account. So, I mean, this is it. I mean, that's the core of what we're talking about here. Again, we wanted to share this in a way where you guys could really see what we're talking about, and hopefully start asking the right questions, right? Like I get it. It took me a while. I know how it was when I first heard about infinite banking using index universal life policies. I know what it was like when I first heard about true debt elimination and what participating whole life policies look like. So these are the underlying policies that fund both what we're talking about as the private reserve account and the diversified cash flow account. Like it took a while for me to understand, okay, how does this actually work? And, what's the math behind it? And we want you to first and foremost be educated as far as what you have. Because if you don't know how your account works, it's going to be hard for you to truly use it in the most fundamental way. So that's part of what we love about what MWR is doing, is that educational piece. They have so much available and they're working with us. We just sent over, I think, Ike, earlier today, we sent on like 6 videos that we're still figuring some of it out, but we're getting everything ready so that you guys are going to be able to take a look, to learn, to understand more. And then as you schedule these appointments with an expert to actually talk with them, what they're going to do is they're going to walk you through these things as well. They're going to answer the questions. They're going to talk, like, we haven't been able to hit on all the benefits that come along with an account like this, right? The underlying structure of this is there's a life insurance policy behind it. So legacy income, like, here's the thing, if something happens to you before you were planning on it, your family's going to be taken care of in a really amazing way, right? There's things that come in that help you out if you were to become disabled, if you were to have a critical illness. Like, there's all these other things too that come along with the fact that you own your bank. And so it always excites me when someone, when that light bulb goes off and they get it, and then they start using it. And then the next thing you know, they're giving you comment like, hey, Edward, I think it's time to pay off that one debt that we were talking about. Like, can you take a look at my report? Like, is it time? Oh yeah, it's time. And actually, that we can pay off the next one too, because the policy, it performed better than we were thinking it was going to perform. Like, I love having those conversations. And then whenever you finally get to that point where someone's entirely paid off as far as debt, now the fun happens. Now we get to use the funds in that account to invest and to grow and to find ways to get leverage. Because if I'm making 4% here and I can borrow at 5%, but I can find an investment, and I know Brian and Ndamo are working on those investments for you guys that you guys have, that if that investment pays me 10%, guess what I get to do? Leverage, right? Like, I'm paying 5%, but it's already my money. And they're paying me 4%. So really, I'm only paying 1% for that loan, but I can make 10% over here. I'm making 9% overall, right? Like, that's the cool thing that I get to do with having a diversified cash flow account that allows me to, again, diversify where my cash flow is coming, but make sure that cash flow is always coming in. Like that's the thing. We don't want to stop that compound interest that's happening year after year after year. So, and Damo, I don't know if we may not have time. I know we're hitting that 1 hour mark here. We tried to squeeze everything in.
No,
and
I know
I'll
you
jump in
guys.
too.
Yes, go
One
ahead,
of the
Ike.
things that one of the things that, I mean, I love these comments too. I mean, you guys are fired up over here, as excited as we are. One of the questions, Edward, I think that's important to point out is for somebody who is filling out the financial worksheet, the importance of, and Brian touched on it a little bit, but just the importance of putting accurate information and what that does for us in our system. If you want to go ahead and answer that, Edward.
Yeah, I mean, and that's what I was trying to say too, as I was going through the financial worksheet that you guys are seeing, which will be very similar, right, Andamo, to the financial snapshot
Right.
that they'll see.
Right. The cash flow
The more
snapshot.
accurate, the more accurate you can be, the more detailed you can be. Like the advisor that you will talk to will ask you those questions as well. But if we have it ahead of time, then we'll be able to come to that first meeting with a report already ready to go. Right. Like the more detail that we have, when we have that first meeting, we'll be able to show you 100%, like, here's what we can do. Right. Now, if we need to get some more information from you, if we don't have 100%, we'll need to get that during that first meeting. Then maybe the second meeting, we can have your report ready. But the more information you give us on the front end, the more detailed and clear we can be on that during that first meeting. Because our goal, we're not trying to slow you guys down. We heard it this weekend. People are ready to go. So we're trying to make sure that we can do it as effectively and efficiently as we can do it for you as well.
Right. So one of the things I know that I was just looking through some of the questions, the few that were out there, everyone, like you said, I had a chance to see it while you were talking, and where people are fired up. They're blown away. They never had this kind of information before. They're excited to do it. I know they want to schedule their consultations right away. Well, you'll be able to start doing that as early as Monday. But one of the fundamental things I want people to understand, because this kind of account can meet you where you are. So can you talk about if someone has their checking account, they kind of still need to use that because that's just kind of taking care of their current lifestyle. But if they have a savings account and they have a lot of money sitting there, or if they've never really been able to put together a savings account, they really save out of their checking account, but they want to just put this on a monthly basis. Can that happen? Can we meet people where they are? Because they were saying, is there a minimum or is there a maximum? And I know it depends on someone's specific situation. That's why I love what we do, because it's never a rule of thumb. It's all based on your specific situation. And as you, Edward, and Ike, you guys could both speak to, everyone's financial situation is like a fingerprint. They're all different. So I know there's nuances to that, but if you can kind of answer that in a general sense.
Yeah. Well, one of the things I like to say is it's like taking money from your left pocket and put it in your right pocket when it comes to saving account and the diversified cash flow account, because there's the only real difference is if you think about some of the things we talked about. I mean, the savings account is going to get you, what it's going to get you. I mean, I saw somebody put 0.01% in the chat, so you know what you're doing with that. And so the best way for me to help people understand it is it's just like that. If you could just do one extra thing without changing anything, any of your finances, just do one extra thing. And instead of it going from the savings to the bills or savings to the check, is now savings to your diversified cash flow account to everything else. And that answers a question as far as everybody's going to be able to save at different levels, and where everybody's at different places. So your own particular situation is going to be different from everybody else. But if you can open up a savings account, most likely you could have a DCA.
Right.
Yeah.
And that. Oh, go ahead, Edward. I'm sorry.
Well, I mean, the only thing I was going to add to that is that, whether you have a lot, as I said, I used to think that only people who had a lot of money ready to go could start something like this. And yes, if you have funds that are just not really working for you, a lot of cash sitting in a savings account somewhere that you want to have quick access to, but you would like it to earn more than the 0.01% or the whatever those numbers that people are putting in for their local savings account. Like, yes, this can work for that person, but this can, like, one of my favorite clients, she is funding her account with $200 a month. And over the last 3 years, we've already paid off 6 outstanding debts that she's been working.
Yeah.
We have about 4 or 5 more to go, and she's going to be debt free from $200 a month. It's like it just where you are, what your situation is. We're going to take a look, and we're going to give you the best advice based off of what we have. And here's the thing: there are some people that now might not be the right time. They may just not have that. If you're spending more money than you're making, this is probably not going to work. Like we got to adjust some things. But what I've seen from most people, if we really take a good hard look at what's going on and what's going out, and you have a desire to make this kind of shift in your lifestyle and get out of debt permanently and build this kind of bank for yourself, we can find a way to make that work for you. You just have to want it.
No, absolutely, 1,000%. And the great thing about MWR is not only do we help people increase their cash flow out of their current income, but we also, not only that, but we help you kind of move in a direction to create cash flow. So you have a business income so you can make more money to be able to accelerate and do the things you want to do. With that, ladies and gentlemen, you know what we say here. See, this is how, when you here at MWR, and we know we're going to see you at the top. We know we'll see you on the beaches of the world. Why? Because you're going to be able to afford to be there, because you're letting your money do the right thing for you. But we're also going to see you at the bank. And guess what? It's your bank. And at the MWR bank, in your bank, they won't just count our money. They'll weigh it. Have a great evening, everybody. Good night. Appreciate you all.